Okay, I want you to picture something for me. It's 1998. The world is going absolutely nuts for the internet, right? New companies are popping up left and right, and every investor is convinced they've found the next big thing. So maybe you take your savings, you pour it into a few tech stocks just because they have these catchy .com names. And for a couple of years, you look like a genius. But then, damn, the year 2000 hits, the bubble bursts. And today, it's hard not to feel that exact same energy all over again. But this time, it's not the internet, it's AI.
I mean, the dot-com crash was just, wow. It was breathtaking. The NASDAQ, which is just packed with all those tech stocks, it plummeted by nearly 80%. Just try to imagine that for a second, watching your entire portfolio lose 4/5 of its value. Over half of all those super promising dot-com companies, gone. Bankrupt, vanished almost overnight. People lost millions, literally in the blink of an eye. And here's the crazy part. The internet was the next big thing. They were right about that. But even so, all that overconfidence, the pure hype, it created one of the biggest speculative bubbles in history.
And that really brings us to this famous quote from the legendary investor John Templeton. He said, "The four most expensive words in investing are, 'This time is different.' Every generation thinks they've found some new era, where the old rules just don't apply. And today, people are calling AI a once-in-a-lifetime opportunity. And hey, maybe they're right. Or maybe history is just doing that thing it does, rhyming. So that's our big question. Is this time actually different? We're going to dig into 3 hidden clues behind this potential AI bubble to find out. Okay, so our first clue. It all comes down to this massive, massive arms race. And the fate of the entire stock market, and yeah, probably your portfolio, is being decided by just 7 companies. You've probably heard of them. They're called the Magnificent Seven. Amazon, Microsoft, Alphabet, Meta, Apple, Tesla, and NVIDIA. And right now, they are all locked in this epic battle to totally dominate artificial intelligence. And the scale of their influence is just staggering. Look at this. These 7 companies now make up around 36% of the entire S&P 500 index. So what does that mean for you? It means even if you just own a simple, boring index fund, you're already making a huge bet on these companies. Like it or not, your financial future is tied directly to how this high-stakes AI race plays out.
And when I say arms race, I am not kidding. These 7 companies are on track to pour a collective $330 billion into AI, just this year alone. That is not a typo. $330 billion. That's a tidal wave of cash, all aimed at one single goal. The scale of this spending it's almost impossible to even wrap your head around.
So to put that number into perspective, that $330 billion, that's more than the entire economic output, the GDP of developed countries like Finland or Portugal. All of that money is being funneled into building the future, what some people are even calling the 4th Industrial Revolution. I mean, this spending is so massive, it feels like it's single-handedly propping up the entire US economy right now.
And let's be clear, this is not just about making smarter apps for your phone. The International Monetary Fund estimates that something like 60% of jobs in the developed world are exposed to AI. That means they could be totally transformed or, even replaced. So whoever cracks this technology first, they're going to be rewarded with a mind-boggling amount of power. And this race isn't just between companies, it's between nations. We're talking the US versus China, both burning through billions to make sure they're the ones holding the reins.
All right, on to our second clue. And honestly, this might be the most worrying sign of a bubble. There's this strange financial loop that seems to be making the entire AI industry look way more profitable than it actually is. It's being called the AI money machine. And trust me, when you see how it works, the red flags just start popping up everywhere. Okay, so follow the money with me on this one. Step 1, a tech giant, say Microsoft, gives billions in funding to an AI lab like OpenAI. Simple enough. Step 2, OpenAI then turns around and pays that same money right back to Microsoft to use their cloud services. Okay. Step 3, Microsoft takes that money and uses it to buy essential AI chips from NVIDIA. And then, the final, craziest step, NVIDIA invests its profits back into companies like, you guessed it, OpenAI. It's this perfect self-feeding loop where cash just gets passed around and every single company gets to record it as revenue, pushing their stock prices higher and higher.
I know. That sounds super complicated, so here's a perfect way to think about it. Imagine you pay your friend $1,000 to dig a hole. Then, he pays you $1,000 to fill that same hole back in. Did you create any real value? Nope. But on paper, you both just made $1,000 in revenue. And if you were valued like an AI startup, your little hole-digging business could suddenly be worth a fortune.
So who's the biggest winner in this whole game? Well, it's NVIDIA. They are literally selling the shovels in this AI gold rush. They sell their chips to everyone, Microsoft, Meta, Google, you name it, and then they invest back into the same companies, buying their stuff. The result? Their stock price has just exploded by over 1,600% since ChatGPT first launched. That's just insane.
And this brings us to the core problem here. For all the hype, for all the billions being passed around, these AI services are just not making enough real profit yet to justify these crazy high stock prices. I mean, OpenAI is currently valued in the hundreds of billions of dollars, but it's reportedly losing money every single month. The valuations just feel totally disconnected from reality.
But what happens if the fuel for this entire AI engine is about to run out? Well, that brings us to our third and final clue, a potential roadblock that could stop AI's incredible progress right in its tracks. And it's called the data wall.
So what is this data wall? Well, for years, AI models have been just devouring every single scrap of public data they can find. Every book, every article, every website. Think about it. We've been feeding these things centuries of human knowledge, from ancient texts all the way to yesterday's tweets. So it's no wonder progress has been so fast. But that well of data is about to run dry.
Yeah, it's predicted that by the year 2027, which is just a few years away, AI models will have consumed pretty much all of the human-generated content on the public internet. This isn't some distant sci-fi problem. This is right around the corner. It's an imminent challenge.
Okay, so here's why that matters so much. The entire investment case for AI is built on this belief that progress will just keep accelerating. But if the models can't get significantly better because they've run out of new data to learn from, well, then the market's sky-high expectations could come crashing right back down to earth. And that, my friends, is when a bubble truly bursts.
So we've looked at the clues, a massive arms race, a kind of weird money machine, and this approaching data wall. So, is this just the dot-com bubble all over again? And maybe more importantly, what on earth should you be doing with your money right now? Let's get to the verdict, and then your survival guide.
So, is this the same as the dot-com era? My take, no, not exactly. The huge difference is that today's AI companies actually have real products with real utility. Unlike a company like Pets.com, which was basically just selling dog food online, today's AI is already being used to discover new drugs and optimize global supply chains. It's creating actual measurable value. So here's my verdict. Yes, it absolutely has all the signs of a bubble, but it's a bubble with a much, much more solid foundation.
And surviving this doesn't require some crazy, complex, risky strategy. It's actually all about smart, defensive plays. First, just keep investing. Set up an automated monthly investment into a broad, low-cost index fund. This way, you benefit if the market keeps climbing, but if it crashes, you're automatically buying in at a discount. Second, focus on increasing your income. Get that promotion, start that side hustle, because that's the fuel for your investments. And third, diversify. The key to surviving any market bubble is just not having all your eggs in one basket. Spreading your money across different things like stocks, bonds, and real estate is your best defense against all this chaos.
Look, a crash or a bubble bursting isn't the end of the world. In fact, if you actually understand what's going on and you have a plan, you won't be one of the people panicking. The real secret to all of this is that market downturns are when fortunes are actually made. So the final question is this. When the panic starts, are you going to be running for the exit with everyone else, or will you be the one who's prepared to seize the opportunity?